Yo, this is a hot take, but this is why I believe that fundamentals do not matter in a bull run. So that means revenue, their cash flow, whatever, it does not matter in bull runs, and this is why. So disclaimer, everything said in this video is only for educational purposes. Make sure to always do your own research. But this is why you should listen to me, Midas. Will I beat the S&P 500 by 103x? If you want to take a look at the proof of this, check out my YouTube description on my link tree. They'll show you the date of my calls, the takers I invested in, as well as where the call was posted, whether it's YouTube or TikTok, and my total P&L, which is worth 4,000%. If you want to take a look at all my stock and crypto picks, check out my YouTube description on my link tree. I'm also launching an exclusive Discord community. So if you want to take a look at that, join the waitlist on my YouTube description on my link tree. I'm planning to drop a lot of exclusive alpha there before my YouTube or TikTok, so check it out. But this is why fundamentals do not matter in a bull run. This is an example. If you want to pause the video here, you can take a look at this post on value investing as to why Microstrategy is, a bullshit company or whatever. But the point I'm trying to get is that people are all like this guy. They don't understand MicroStrategy. They don't understand how a company that doesn't do anything and just holds crypto like Bitcoin is able to have a 100 billion valuation. This is a bull run, okay? Bull runs means that you can throw all common sense out the door for most stocks. If there's some sort of hype to it, like a narrative, it's going to skyrocket. And MicroStrategy is definitely one of them. It just holds Bitcoin, and because it holds the most Bitcoin in the world, it's just skyrocketing year after year just from the value of Bitcoin. And hype and speculation drive prices. Investor, they pour money into the next big thing. The price moves ahead of reality where you're chasing potential instead of profit, especially in a bull run. Like OKLO, they haven't even made a nuclear data or nuclear center yet, and they're already worth 20 billion. That is completely insane. But this is what I mean. Hype and speculation drive prices. If you rely purely on fundamentals, you will get burned and you will miss so many companies like Palantir, OKLO, Big Bear AI, who might not be doing very well at the very start, but give them time, let their contracts fill in, and they're going to make a lot more money. And companies without revenue can still rocket. Startups and tech firms can have little or no revenue initially, but market values them based off of their technical disruption potential and their user growth. Like people thought that Reddit wasn't that good when they first IPO'd, but look at it now. And bull runs are about momentum, not metrics. When the market is bullish, everyone wants in. This fear of missing out fuels buying beyond fundamentals. And plus, when you think about it, the average investor doesn't even know about fundamentals. They just know about hype. They just know about the narrative. They just know the Palantir bought in. That's what they're going to buy in as well. They don't really care about the revenue or expenses. And if they do, they're probably a trader or they're probably someone that is more a value investor. But betting on the future, not the present, investors buy vision and innovation, hoping the company delivers later. Early adopters take that risk for asymmetric returns. And relying only on fundamentals means missing out. I see this comment all the time. They're like, why, Midas? Why are you trying to bet on these companies that make no revenue? They're all shitty companies. They're all just going to crash later on. But strict fundamental investors, like these guys, get left behind. They likely did not invest in Palantir when it had a 100 PE ratio because, well, they're not making any money. Same with Tesla. And look at the companies now. Just because they're not making revenues before or when they're first started does not mean they can't turn it around 180 in less than a year. And bull market reward boldness and risk taking more than safety. Keep that in mind. So when do fundamentals matter? You might be wondering. Bear markets. This bear markets are when you should only worry about the fundamentals when you're investing in companies. Because bear markets are when reality sets in. The prices drop, so investors scrutinize earnings and cash flow. Weak companies get punished and strong ones get more opportunities. And capital preservation is key. Focus on companies with solid balance sheets and profits. This reduces risk while waiting for the next bull run. And the best time to invest in fundamentals is when you're buying undervalued, high quality stocks at discounts. So you should build a resilient portfolio ready to explode in the next bull run. A wise man once said that the way to make money is not on a bull run, but actually in the bear market. Because the bear market is when you're able to buy all these different winners for so cheap, because a lot of people just don't sell in the bull run. So they just beg hold this stock, the companies they have, the portfolios to zero, and just lose all their gains. But if you're watching the channel, you're likely a lot more smarter than the average investor. So that's what I'm trying to say. Always make sure that you're considering when the bear market is going to happen and when the bull market might end. If you have any questions, comment them down below and I'll respond when I can. If you enjoyed the video, subscribe and like for more. I appreciate the support of all my followers. But that's the end of the video. If you have any questions, comment them down. I'll catch you guys in the next one. Peace.